Hello and welcome to the simplerstocks.com video for May 27th. My name is Don Kaufman. Tonight I'm going to look at a trade here on Twitter. Why? Okay, ultimately we're looking at Twitter in just the last couple of sessions, obviously having a wicked earnings announcement, Twitter trading from roughly the 52 level down into the recent level of about the 36 handle, even actually touching right at about the 36 level today on ever kind of declining volume. Not the great sign that you want to see on a stock that's declining over here. But okay, why am I looking at a kind of a short position inside of Twitter right now? Simply put, well, the S&P 500 today was up, okay, and up in a big way. The SPX specifically is up almost 20 points today. The S&P futures closed up about 16. What did Twitter do? Absolutely nothing. Okay, so we're not seeing on Twitter, okay, in terms of the down move over here. Again, I'm not a huge market technician. I'm not going to point out to you what I see technically in terms of the breakdown over here. We do have volume that is kind of lackluster, so you don't want to see a stock falling and not getting significant volume. Why? There's just no means to see capitulation, meaning that if a stock is falling and kind of falling hard, you'd like to see heavy volume, a sign of a little bit of capitulation. That's kind of what we call traders tossing their cookies kind of up a little bit. Tossing your cookie up means exactly what you think it does. They're kind of throwing in the towel, and what we, again, in trading term, barfing up the position. It's tossing up your cookies in a position, and you would usually see, again, heavier amounts of volume. In kind of confluence with that idea on Twitter, what you're not seeing is also you're seeing extremely low implied volatility. Extremely low implied volatility in a product that has been known to be wildly volatile. You don't want to see really low risk metrics when a stock is sliding to the downside, not seeing heavier volume over there. It's actually a very bearish sign. Now, if you are a technician, you're probably looking back here and they go, but it found some support several times right at the 36 level. We touched the 36 level today. Again, not a big increase in volume today. It didn't follow through with the rest of the market and rally to the upside. Therefore, again, looking for a bearish position inside of Twitter. One of two ways you could consider that bearish position. You could get outright short the stock. If you get outright short the stock, okay, I have a tendency to talk about, all right, so if you're going to short the stock over here, where are you going to bail out of the stock? Look about 30 days out. Even though I think if Twitter breaks down, it's going to break down well inside the 30-day range. I'm actually using the options again to kind of depict the expected move. And the expected move inside of Twitter over the next 30 days is about plus or minus, okay, let's call it $2.75. So roughly speaking, what that means is if you're going to use a stop order on stock, okay, and you're going to get short, where ultimately would you want to bail out? All right, and you're going to be bailing out somewhere in the neighborhood of about right around the $40 range, just maybe above like the $40 range. That's the kind of heat you would have to take if Twitter pops right here at about the 40 range is where you'd have to buy in your short position. Again, if that's one of using the stock side of the trade over there, that would be a reasonable place to consider. Remember, when you use stock and you use stop orders, you have to give that underlying some breathing room, and I'm using the option risk metrics to measure how much I'm going to allow the stock to move either for me or kind of against me over here. So again, in and around that kind of 40 region, I'm comfortable saying it's a little above and beyond the $2.75. But again, Twitter has some volatility in it. Now, if you consider trading options and you would like to construct the trade in options, I've actually built a spread. I built the spread using the June options. They're about 23 days prior to expiration. This is a 37.50, 35.50 put spread. It's trading for about $1.08 debit. If you take a look at the 37.50 puts, okay, those puts are already said to be quote unquote in the money by how much? $1.09. But you can actually buy the entire spread right now, okay, for $1.08, meaning that there's no time value, no time exposure in the spread. Roughly speaking, the spread risks about $1 to be able to make very close to $1. It's a $2 wide spread. The most you can make in a $2 wide spread is $2. You pay $1.08 up front. Sure, you have about 92 cents upside, but it defines your risk. Twitter can explode to $50. The most you can lose here is $1.08. Look at your risk first, then discuss what some of the reward can be. In this case, to maximize profit potential, you only need Twitter down to 35.50. We're already at 36.41. I'm not asking for a miracle. I'm asking for Twitter to do exactly what it has been doing kind of day in and day out, and that's trickle to the downside. Thanks a lot for joining us here at simplerstocks.com. My name is Don Kaufman. See you guys later in the week. Bye-bye.